I'm Doug McKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome back, everybody. Happy 2024.
Yeah, wow. And it's no snow yet, but it's certainly cold. I felt
it's
it
not
today.
that bad.
Well, I'm a baby, I guess.
Yeah. You just can't say it's cold yet because the real cold hasn't come.
Yeah, well, that's true.
When the real cold comes, today's going to be like I'd be walking outside in a t-shirt.
Well, you know, I've told you that my brother Ray, he lives in Iowa, and many times the weather that we're going to get here in New Hampshire is what they had a couple days before, so a couple days prior. And you know, he calls me many times when he goes out for a walk, and he has earmuffs and he's got all kinds of layers. He's got insulated pants. And I have to say, you know, I'm sure he's warm, but when you get your first, you know, string of 20-degree days, right, where it doesn't get really above 20, right? So that's the high. Yeah, you bundle up. And I tell you, I went out for a walk just a little while ago and I bundled up, you know, and I like feeling a little cold. But after a while, if it's cold enough, it gets right inside your bones, right?
It seeps in.
It really seeps in. And I usually, you know, unlayer as I get in my car to drive home because I drive to the spot that I go for walks. And then today I didn't do that. I got in the car, I still had the heat on. I only had to drive like 7 or 8 minutes to get to the grocery store, but I got there and I stayed bundled up. And I'll tell you, when I got out of the car to go into the grocery store, I was like, yeah, I'm looking forward to getting inside again. Because, yeah, I guess I am. I'm a baby.
You might need to fatten up a little bit.
Well, that's not going to happen. It hasn't happened all these years. You know, I should have fattened up over the last few weeks with all the cookies I've been eating.
I know.
Well, I made like 6 or 7 types of cookies.
Well, this is the time of year that you get a pass on that.
But I don't get fat.
No, you don't.
You know, no. And I get smaller if I don't stay physically active. It's like
okay.
My body shrinks.
Yeah.
So I have to stay, you know, at least strong, firm.
I realize that most of our listeners don't know what we look like aside from our faces, but we're both pretty
trim,
thick, thin guys.
Yeah. Which
not a lot of meat on the bone.
Some people call me skinny, and you know, I don't get offended like one of my sisters does. You know, she's older than me, but she's so tired of hearing, "Well, you can eat whatever you want because you're skinny," and she doesn't even like food. You know, so they'd be like. And she said, well, you know, you can't say that about the opposite end of the scale, if you know what I mean, without using the F word.
Yeah.
That ends in a T. You know, you can't say, well, you shouldn't have that because you're, you know, but hey, right. You can have that because you're skinny.
Yeah.
It's not always a compliment. It's meant to probably be a compliment, but it's kind of a backhanded compliment. You're skinny. Well, you're skinny. Anyways, thanks for listening, everybody. That's the show for today. No.
Oh, my God.
Just kidding. Thanks for listening to all that baloney. Okay.
So, we are going to talk about, it was an interesting question that we got from someone that we know that asked us why we don't talk about or focus more on annuities. And I think that, I mean, at least I had a better understanding of what an annuity was before I had an understanding of what a whole life insurance contract was. And maybe if our listeners don't, you know, we can give you a brief overview, but it's a very commonly used insurance product. You're basically providing the insurance company with either, there's so many different types, so I'm not going to encompass them all right now, but the overview is that you're going to provide them with either before or after tax money in a lump sum or a series of payments, and upfront you are agreeing to how much money they're going to give you for the rest of your life. There's a lot of different caveats that come with that. So it could be the rest of your life. And then if you die sooner than a certain age, they return a certain amount, or they're going to give a certain amount to a surviving family member, spouse. But anyways, the gist of that is you're basically buying your own fixed income contract. Am I getting that right, John?
Yeah, yeah. I mean, eventually, when you do the verb version of the word, annuitize it, you turn it on, it creates this annual or monthly set, amount that and it's locked in, and yeah, I kind of joke when people ask me, right? They'll say, "Why don't you do annuities or IULs?" And I say, "Well, because I don't like to make money, because honestly, it'd be easier to sell both of them. First of all, because there's so much marketing behind it. We've talked about that with IULs, but there's so much marketing behind annuities. You see commercials on TV about annuities.
Isn't it interesting that you say that actually? Because lately on Facebook, I've been getting ads for IULs and annuities, but I've never once seen
Oh,
ever
okay.
an ad for whole life insurance ever.
Yeah.
Huh.
Yeah, me neither,
And
right?
I
Right.
hadn't thought about that. I mean, I've seen ads for
No.
annuities a million times, but I've recently started seeing a big uptick in IUL marketing.
Oh yeah, it's
Yeah.
huge. Well, they're after me, that's for sure, all the time to try, different
But
organizations to try to, say,
yeah,
hey,
same. And
yeah,
and again, we did the episode on IULs previously. It's not inherently a bad product. It can be if it's not designed correctly. Um, and annuities, especially though, they're not a bad product. What they do, they're really good at removing risk from a
yeah,
financial
yeah.
portfolio.
I
And
mean,
and
there's
for
a
a lot
place
of
for
people,
those for sure.
yeah,
Yeah,
for a lot of people, they're a really good fit. They
yeah.
really are.
And we can do annuities, so
Yes.
it's
But
just
we really don't, at
yeah,
this point, neither of us really focus on them very much. And what we thought we'd talk about today is why that is, because it was a good question.
yeah.
And so, John, you can correct me if I am not speaking correctly for both of us, but the reason that I don't, if I had somebody that could qualify for a whole life insurance policy, and there's none of that underwriting really that needs to be done in the same way. They're still going to look at your rating class and stuff like that for an annuity, but it's a little bit more difficult to qualify for a whole life product. But if I have somebody that can qualify for a whole life product, I would almost always recommend that they go with that over an annuity, and there are some reasons behind that.
Wow,
So
yeah, yeah. And I can say that it's interesting, right? In this kind of niche space, and certainly we are even in a niche of the life insurance industry, but we know a fair amount of people that do this work. As you do it, you meet a lot of people, and it's just telling the audience that's the way it goes. And it's amazing how many are, in their 70s, some are in their 80s, and they're still agents. They're still writing business. They're not retiring from this business. They enjoy it. They have the cognitive ability. They have the energy. They love it, right? And when they put a they if they can, they still put new policies on themselves. These guys and girls aren't putting annuities on themselves. They're
no,
buying more whole life. And I have to say, I'm not quite those ages, but I'm in my early 60s, and I just wrote a new policy on myself, and I did a whole life. I'm not doing, I could go get an annuity. It's easy enough. Um, I put that on myself and know that I got this guarantee and all that kind of stuff. but there's reasons, and we're going to get into it. Mostly for me, it's always options and flexibility, right? That's the core.
It's exactly what it is. So it's kind of like I'm sure a lot of people have heard the phrase, once you turn a cucumber into a pickle, it's never going to become a cucumber again, right?
Yeah.
And
I have heard it now.
well, if you have the ability, so I think we've talked about this on the show before, you can annuitize your whole life contract. And we're not talking about, some formal option within the insurance company to do that, but it's easy enough to do with your agent to where you can go, okay, I'd like to start streaming income now from my policy. And you look at you look with your agent, and it's very easy to do within the software, and you can pretty reliably stream out a set level of income over a long period of time, and you can know comfortably, how long that's going to last. Very similar to an annuity. Okay. So you
Yeah.
have the optionality to do that. At
Yeah.
the same time, if you were to, let's say, get a lump sum of money in that period of time, you could put it back into the policy, pay off some of that loan, and you have access again to that cash that you were streaming out, thus changing your outcome. So you can also use it for different purposes during that time. Okay.
Yeah.
John, what did you want to add there?
Well, I mean, I think that's the crux of it. That I want to have the flexibility to spend the way I want to spend.
Mm-hmm.
I'm not locked in. Uh, what's the saying that many retirees will come up with? I'm on a fixed income.
I'm on a fixed income. Yeah.
Yeah, and I'm not fixed. I didn't fix it. I have a, a pile of liquid cash available,
Yep.
and I can take it out. If I want to distribute some of it, I can do that all the way up to every dollar that I've put in premiums, and that's obviously not income.
Nope.
It's just you're just taking it back, so you're not paying anything on that. And then if you go over that cost basis, then you can take loans. I mean, you could, like you said, you could continue to take loans
Yep.
right from the start. You don't have to distribute it in that way, especially if you know there's going to be potentially windfalls,
Mm-hmm.
or you are going to be working still, right? So you've got some additional cash flow, and
Yep.
if you want, you can stick it in. So it leaves you all those options. I just want to know that if I need to spend because I'm going to do something special this year, I got to spend 20% more than I spent last year. I can do it. Doesn't mean I have to cut back. Doesn't mean I can't do that for 2 or 3 years in a row. It just means I have the option to take what I need, and I can do it all tax free.
Right. Yeah. Yeah, well said. The tax-free thing is nice too. I mean, again, it depends on what kind of money is going into your annuity, post-tax, pre-tax. But a lot of people are paying taxes on annuitized distributions. Um, and you're once the annuity is annuitized, you're going to get those distributions no matter what every single year, whether you need it or not.
Yeah, yeah,
Which isn't
exactly.
It's really not a bad thing necessarily, but I'd prefer to have more control over the situation. And I know a lot of people, an insurance product is they're not their only source of income. They might have money in the stock market. They might, like you said, they might still be making money through a profession. And so it's nice to have something where you can decide to take a distribution one year. Let's say the stock market's down. Okay, I'm going to take a distribution this year and not take out of my 401k because I'm going to be depleting it while it's lower. Or I had a great year at work this year, so I really am not going to take anything out this year. But next year, maybe I am going to take out, and you have the flexibility to do that. The other thing that I love about the whole life contract versus an annuity, depending on how you set it up, a lot of times it's funded for a longer period of time to be used later on, similar to a lot of other qualified accounts that, we're all used to talking about. So it's kind of setting aside that nest egg for later on. And there are ways to access money within an annuity that you have built up. The rules around it can be a little bit, it's certainly not nearly as easy as taking a policy loan from a whole life policy. But when I look at my whole life policies, I mean, I use those continuously now in my 30s, and then I know that I will have those later on in life if I get to the point where I don't want to work as much or I'm not working at all and I need to take reliable passive income. So it allows me to use it now consistently in a way that's more advantageous than anything that I know of, and
Yep.
also be able to have that benefit of reliable income later on. I mean, and that's why a lot of people incorporate insurance products into their financial portfolios, because even when we talked about this previously, when we look at things like bonds that are, more secure and less susceptible to drawdowns, they're really still pretty susceptible to drawdowns. All we have to do is go back and look at the bond market over the last few years. And so it is really good to have these products in our financial portfolio, and annuities can serve a really good purpose with that. But what we're saying is that we think that a whole life product can essentially do exactly what an annuity would do, but give you a lot of other optionality.
Yeah, for sure. It's a little bit, it's funny, right? The way my mind works is I want to emphasize something that, because you said, like, hey, if you end up wanting to put the money in, it doesn't always have to be a loan. You just have to have the room in the policy to put the premium dollars in, like the paid up additions, which is
Mm-hmm.
optional, but you don't have all the same optionality. You have the first 7 years. I want to emphasize this. Whatever amount you average. Now, let's just take a hypothetical example that your total premium, maximum premium's 10, your minimum's 5. You can put in the other 5 if you want. But whatever you average in that optional amount, so if you only averaged 4 for the first 7 years, well, then you can only put in 4 for years beyond that, right? And if you skip a year and don't put any in, or you shortfall it during those first 7 years, you can make up for it the next year, right? But you only have 1 year, at least the insurance companies that I work with, right? You only have that 1 year to make up. And the reason I'm saying all this is because if you do the max, ideally we want to structure something that you can do,
Yep.
and that and keep you on track to say, I am going to max this out. I am going to put in the maximum optional amount every year, at least for the first 7 years, because years 8 and beyond, I have the flexibility now that I can put that in. I might not do it in year 8 and 9, but I can do it in 10, right?
Yep.
So, and that can be important as you get into some later years. We're not talking about everybody's going to be in their 60s and 70s and 80s to retire. There's people that retire at 50,
Yep.
you know,
Yep.
and but they have I say retire maybe from their their 9 to 5 job, but they're doing other things.
Yep.
And they have other cash flow. And do they have the room to store this cash in a place that is forever, right? That they're going to be able to utilize it, right? So I just wanted to add that. If that makes
Yeah,
sense.
it's a really good point. I mean, you really can't, I mean, not really, you can't practice infinite banking from an annuity, right? I mean,
Right, right.
it again, it is what it is. It's great. I'm going to give you this much up front, and it's insurance against living too long. And we will pay you, the insurance company says, we will pay you that amount every year till you die. So if you live to be like 110 years old, you've done great. You've really gotten one over on the insurance company. And it's nice because you don't have to think about that. I'm going to get that check every month. But there's a lot of optionality left on the table. And whereas you could still really utilize a whole life policy the exact same way and be using it as a place to store and grow your banking system throughout the years before you pass away. Not to mention a really, probably substantial death benefit, which again is something that, depending on how the annuities, they don't, it's not the same. It's not life insurance, right? So
Right.
there can be things that can be passed on when the insured passes away, but it's not going to be to the same level as a whole life death benefit.
Yeah. Yeah.
So when you're looking at really trying to set up generational wealth, which a lot of our clients are, they're not really comparable. But, we have people that are older or have had health issues that don't qualify. They cannot qualify for a whole life policy, but they could qualify for an annuity.
Well, yeah, they can't qualify health-wise, but they have income, so they have a stash of cash or whatever, right?
And I'll tell you right now, if I was in a position where I could not get a whole life policy for myself or family members, like I just wasn't an option, I'd be implementing annuities at some point for sure.
Oh, yeah, for sure.
Yeah. So I just want to make that clear. We're not, just want to say it again, we're not bashing annuities at all, but it was a good question. Hey, why don't we? It came up as many of our episodes do with John and I chatting before this. We said we should talk about this one.
Yeah, we definitely should. And we'd like people ask questions about them, and again, that helps us too.
Yeah.
There's always some really good questions that I got to look into and get back to people on if I don't have the answer. So so hopefully that's helpful, and if it isn't, let us know.
Definitely. Well, I think that's all I got, John. You?
Yep, that's all I got. Yeah.
Well, happy 2024. Hopefully everybody's over their hangovers at this point.
Yeah, I certainly am, because I didn't get one.
Same.
Great. All right, Doug. Happy New Year, everyone.
You too, my friend.
All right, we'll talk soon.
Later.
Bye.
Bye.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.